We're talking online share investing. Still with me in the studio, Gusta Binikos, FNB Share Investing, Duncan Ingram from ABSA Stockbrokers, and from our Cape Town bureau, Mark Meyer from Sharenet. Let's go back to where we were before that break. Is it really necessary, Gusta, for us, for people like me who want to get into this market, to start looking at all the software and all of these numbers and all of the... I got 7% for maths in standard 8.
Look, I think it depends. It's difficult to generalize, but I think the most important thing is to look at shares or investing in shares as part of a bigger plan. You need some cash in emergency situations. You need some liquidity around that. You need some property. You possibly need some bonds and a unit trust in there. So gold and shares make a part of a bigger investment strategy that says that you should have a little bit of each, or endeavor to build your portfolio up like that over time, because you are actually diversifying your risk. You're mitigating your risk by not putting it all into one instrument. Having said that, the man on the street that you're talking about is not going to be able to populate those type of spreadsheets. You're going to normally have to go to a one-day workshop. There's a lot of freeware available on the internet if you search it. Some more pertinent to our market, some maybe more to biased towards the US. But if there were any package that could do it, we'd all be wealthy.
Yeah, tell me about it.
And that is the bottom line.
And the person who created it would be the wealthiest of all.
Would be the wealthiest of all.
Yeah.
And I think it's a bit of instinct. I think it's a bit of speaking to people that know. And it's ultimately deciding on whether you want to actually make an income out of this, which is a total different ballgame, or whether you're going to put this down for the long haul. You're looking at a 5, 10, 20-year view.
Okay, I would imagine, and I'm generalizing here, but I'm talking on my behalf and on hopefully your behalf as the viewer to this sort of program, that you are looking at doing this for the long haul and as a mix in investments, as Gusta was discussing. Mark, if I was looking at that mix, what sort of percentage, I'll take 100 Rand, what sort of percentage should I be putting into, in your opinion, into the share market?
Very good question, Jeremy. It's a question we get asked a lot. Just from reading and from the popular opinions out there from financial advisors and so on, there seems to be an understanding that you should have a long-term outlook, and that should constitute a good 50 to 60, if not more, percent of your portfolio. Then there's a strong 20% to 30%, if not more, gain of property. And then there should be a certain level of speculation in there as well. It's the higher risk but higher reward aspect of your portfolio. But having said all that, it really comes down to where in your life cycle you are. If you're a up and coming 25, 30-year-old who's got a long amount of time to still spend in the workplace generating cash, then you can be a little bit more risky up front. If you fail on the markets, you've got a long time to make it back. If you're on the other end of the spectrum and you're retiring in a couple of years' time, the wisdom there is to rather have less of exposure to a more risky portfolio and increase your investments in dividend yielding stocks, blue chips, and perhaps even bonds.
Do we, as South Africans, we don't save enough, for one. Do we invest enough?
I don't believe so, Jeremy.
Can we invest? I mean, if you look at the price increases that your average man on the street has been hit with in the last year, do we actually have disposable income to be investing with?
I don't believe at the moment, Jeremy. I think, as you've mentioned, your average South African is under a lot of pressure, concerns about job security. Mm-hmm. The inflation rate that the man on the ground is experiencing is nowhere near the official inflation rate. We've had electricity price increases of 25%, and that looks like it's set to continue.
Yeah.
Worries about toll fees, particularly in Gauteng. That's going to hit people who commute from Pretoria to Joburg very hard. So I think in many cases, the last thing on their mind is actually saving or investing.
How do we change that culture? Because the problem is that, yes, I understand the situation people are in right now and they don't have that disposable income, or they're not creating that disposable income because there are other ways of saving money so that you've got disposable income to invest. But how do you change that mindset? How do we start telling people or explaining to people that they, despite how bad it is now, they've actually got to invest for the future, because 10 years down the line, maybe 10 years too late?
I think the important thing is it's relative to your own situation. So regardless of what your income is, if you can get to the behavior, regardless of what the amount should be, if you can get to the behavior of putting money away, whether it starts with coins in a jar, and the coins in the jar become the savings account that you open. And the savings account is where you top up 10 rands, 20 rands, 30 rands. It's relative to the individual. But we believe that there's a much higher consciousness at the moment, and it's coming out a bit of guilt, where people are, some of them have recovered, but they're saying, you know, I'm starting to buy luxuries. It's relative to the segment that you are talking to. Then there's also still a lot of disposable income in some segments, but they choose to do different things with it. So I think it's really your propensity towards risk rather than just your physical income or your ability to do a lump sum trade. It's more an attitude. It is a philosophy to say that I can penny pinch off my income every month and put it away where I forget it until it accumulates to something that allows me to, for instance, buy my first shares or my first Satrix or what it is that I feel that I should be investing in.
Mark, I was speaking quite a few years ago to a financial advisor, and he gave me a very good piece of advice. He said, you need to start building up a share portfolio. Because he said, one day when you retire, you need a reason to get out of bed. Your reason to get out of bed is to be there to see when the market opens what it's opening at, and to be there at 4:30 to see what your position that you take on closing is. I'm not suggesting at all that I'm ready to retire, but I found that a fascinating piece of advice. Are there people who are building these sort of portfolios towards that sort of goal?
Well, if the goal's waking up at 4:30 in the morning, then you can count me out, Jimmy. But, I'm not a morning person. But yes, there are people who are using now as an opportunity to build up for the future. And it is something that is very interesting. I personally have a love affair with the markets, and it would be something that I'd like to do into my retirement as well. It'd keep me stimulated, keep me interested. And it possibly actually beckons an important point here, in that one has to be very honest to themselves when they're deciding, well, is it time for me to open up an online trading account and doing this myself? And that is, am I going to make a sustained and long-term commitment? Because that's what's required here. It does mean that you have to put in the hours. There will be some sacrifice in time, and you need to be prepared for that.
Give us a feel for your market. Who are you dealing with here?
Our market's varied. It's on the one side of the spectrum. You have students who are at university who are studying commerce and investment and portfolio management is one of their subjects, and they want to start dabbling their toes into the market now. And often for them that means opening up a CFD account, which is a platform we offer in partnership with IG Markets.
Okay, talk English to me, Mark, talk English to me. Don't say things like CFD.
A CFD account is a contract for difference, and it allows the client to have put less money down as a margin or a deposit, and then the institution that they're trading with then goes and buys the underlying share. And it means that if you put 100 Rand down and it's only a 10% deposit requirement, and the share was to go up 10%, you actually earn a full 100% on your initial 100 Rand deposit. So 1,000 would be exposed in the markets. That would go up to 1,100 Rand, but you only put in 100 Rand, and you get the full benefit of the additional 100 Rand that was earned on the 1,000. So it's a great way to get started in the markets when you've got less income available or less capital to start with. But having said that, of course, the risks are greater as well because it works in the reverse.
Your sort of market, is it also very general?
Very broad indeed. We also have students, commerce students, wanting to learn more about how the market operates. We also have parents who've set up accounts for their children and are helping them understand the markets. We also have retirees. We've got clients in their 90s who are regular traders, and it's how they keep themselves active. They maybe have a portfolio that they've set aside for the grandchildren.
Is it simple? Is it easy to get involved here? And if so, let's say that I'm a client of FNB. How would I go about getting into this particular area?
Well, it's basically built inside our banking system. So it's sitting in your online banking. So you would log on to your online banking. If you haven't got the account, you can open the account yourself, back end within 2 minutes. You can then fund the account immediately and trade within possibly 5 minutes.
And I would imagine all banks offer this service as well. Most of them.
I can't speak on behalf.
The top 4 probably would.
Certainly.
Yeah. I'm not sure if the other banks are integrated in the transactional banking side. They do have a platform that they operate off. But I think what I'd like to add as well is that we've seen, because we have a bank view on customers' behavior, the flow of funds, in terms of the trends that we are picking up, is that particularly in a low interest rate environment, where the individual is a investor only, so they've got no more debt, they're typically a retired individual, and they were living off the interest of their fixed deposit or their money market. When rates go down, it's hippie parade for everybody that's got debt. Yeah. But they get to a point where they realize they need to take the higher risk to get the higher return, because that is their income.
And those are the pensioners.
Yes, and they don't want to touch their capital.
Yeah.
So we're seeing an influx of, we've had one gem of a story where we opened via telephone, we coached a 90-year-old customer to open his online banking and open his account and fund it and do his first trade, 2 hours. But it was a celebration for us, and he was empowered to now do it himself.
That's a lovely, lovely story.
There's no old age.
And that's where we're going to have to leave it. Thank you, gentlemen and lady, for joining me this evening.